Hi, this is Ankur. In this video, we'll talk about life cycle of a company. Yes, just like human beings or other living beings, even a company is an artificial person. It is born and it has to die one day. As an analyst, as an investor, your task is to understand what is the time frame or time horizon for the company to survive. This makes a lot of difference. So it is extremely important to understand the concept of life cycle of a company so that you can take better decisions related to the company's investment. So in this chart, you can see that there are two lines. One is the profitability line and the other is the revenue line, and there is a time. We are talking of revenue or profit only. So usually when it is a startup or a new idea, the revenue may start, but usually the profit is not there. It's actually in losses, especially for product based companies. Services may still start with a very low margin or profitability, but a software company or any product based company or even a manufacturing entity will usually see losses initially, and as the growth momentum picks up, it reaches the growth stage where the revenue growth will be very high, upwards of 20% per annum. I'm referring to. Often startups may see 20%, 30% revenue growth per month. So that's a massive level of revenue growth that startups see. But normally we categorize that 20% return, 25% return on revenue level on an annual basis is good to be categorized as growth companies. And at growth category, we are also looking at the profitability. So usually you will see that return on equity, return on investments will be positive numbers, and upwards of 15% bare minimum you will see. This may not be sacrosanct across all companies. This is a general trend of a good company, how they survive. There would be many companies that don't even make from introduction to a growth phase. A lot of startups that you hear, even getting into IPO, we don't know whether from introduction, so-called growth, because these companies have never seen profit, so I don't know how to categorize them. It will be still an introduction. It can directly go to the decline stage. So it's not sacrosanct that a company has to follow these paths. It can follow its own path. Generally speaking, if you think of standard companies, they would care about profitability, and from that comes survival of the company. If a company is not profitable, they can't survive. So in growth phase, you will see profitability, you will see cash flows, and accordingly it enters mature category. At maturity level, the revenues may be increasing at 5% or so, and in the decline stage, as the name suggests, revenue starts declining, profitability also declines, and it enters into either a loss category, loss making entity, or a very low profit making entity. So in terms of the growth, I would say that from a listed space, I would say Indian Energy Exchange IEX would be categorized as growth company. In maturity, I would pick Asian Paints, and in decline, we will say Colgate. So let's look at these three companies to understand why I'm saying that these companies will be categorized in these buckets. So I'm not talking of the introduction, because introduction would be mostly startups or companies with no profit. It's very difficult to figure out at this stage. Often this could be a private category and not a publicly listed company. So the only way you get access to this is you become an angel investor or you invest through VCs. This is not my expert area, so I will not comment on this. I will talk about something on the listed space. So here are the three companies. Let's look at these companies, why I am saying this is growth, Asian Paints is mature, and Colgate is on a decline. So here is an Indian Energy Exchange. Disclaimer here, I hold this position in client's portfolio and in my personal portfolio. This company holds 95% exchange market for India. So there is trading happens on their platform. So let's focus on our understanding why I am categorizing this as growth. There are two factors to look at. First is the revenue, the other is the profit. So you can look at the compounding that is happening in the recent past, 34% for last year, even 3 years it's 19%. And as this sector is increasing, because the regulations are increasing, we want more clean energy, there is a momentum on the revenue on this. That's why it's continuously increasing if you see. Although I stated 20%, but that's again not a sacrosanct number. It is increasing. It may settle here or decline, but at this point in time, it is at a high revenue growth company. You can see the profitability. It's a very high profitable company. That's the growth in profits or EPS, earning per share, you can see. I'm ignoring these stock price changes. Return on equity is upwards of 45%, which is again very high. Another way to look at is what is the return on capital employed. You can very well see that it's a upwards of almost 60% year on year. It is for some other video where we can discuss more about business model and all those things, but at this point in time, the point that I was saying that this is still in a growth phase. Obviously, it is linked to the industry also. We are nowhere near saturation in terms of the clean energy, and this company provides the platform for that clean energy exchange. So there is a good potential for this company to grow from here on. Now we move to the next company, which is Asian Paints. Asian Paints, everyone knows, I don't have to explain about this company. They are 60% market share of Indian paint market. Again, for a different session, why Asian Paint is surviving and thriving in a very competitive environment because of their business model. But let's focus on the profitability of this company. You can see that although in recent past the revenue has been high, profitability is almost zero, but this could be an aberration because commodity prices have increased, especially oil, which is their main raw material. So last 12 months you see zero profit growth. But when we are looking at all these, we look at 3 years, 5 years kind of category, at least 5 years. So we see it's a 14% increase, and we see profits are increasing at 10%. Remember, in IEX our profits were increasing at 45%. Return on equity is also upwards of 25%. The other way to look at profitability is also the ROCE thing. You can see ROCE is high, although it is on a decline. It used to be 59%. It has declined to almost 30% in the year 2022. So definitely margins are shrinking, and which clearly states that at this point in time, this company is in a mature category. Very soon, maybe in a couple of years, we might see this company entering decline stage. I'm not saying it's a bad company. It's a great company. They may do some re-engineering and refine their processes, as well as new markets they may explore. So this will continue, but looks like it is in a mature category right now. Now let's move to Colgate. Everyone knows what Colgate does. They sell toothpaste. Again, it's a 52-53% market share in toothpaste market in India, as well as other neighboring countries. Let's look at the revenue chart. Revenues, you can see 5% revenue, profitability 11%. Although ROI is quite high, and we also see ROCE is on a decline. So that's why I have my reservation whether they will be able to create a new market, because they're already in a saturated market. They are like the leaders in a very crowded market. So we'll see whether they are able to increase the revenue, they are able to reinvent themselves, or they will just survive in a decline stage. And we don't know how long this decline stage takes. Although in this we said that Although in this we said that these are stages of a company, a life cycle of a company, but we also said that we don't know how much time a company takes from introduction to decline. For example, there are a lot of technology companies. For them, this path could be just a 5-year journey. Similarly, if it is a product-based company, example I can give, say Coca-Cola, it has been surviving more than 120 odd years now. So it depends, what kind of product we are talking about, what kind of obsolescence we can see in those products. Understanding life cycle of a company is very important, because if a company survives for long, makes cash flows, you make profitability also in the form of share price increase. If a company does not survive, and if you enter in at a wrong price, the probability is very high that you will not be able to make money, rather you will incur losses. So understanding the life cycle of a company is important, which is indirectly linked with the industry also, and its internal competitive environment within the industry. I hope you like the video and you're able to understand the importance of life cycle of a company. Thank you for watching.